Hello, I'm Kathy Jones, a fixed income strategist here at Schwab. Long-term Treasury yields hit 1.6% late last year, their lowest levels in over 60 years. Since then, bond yields have risen steeply, and over the long run, 2 or 3 years down the road, we expect them to move higher as the economy gradually improves and the Federal Reserve moves back to a more normal policy. But we don't think that the trend of rising rates is necessarily going to be a straight line. It may take a lot of twists and turns. Strategists continue to debate just how high interest rates will go longer term when the economy and monetary policy are more normal. Most people agree on one thing: the low in yields at around 1.6% is probably behind us. Our view is that a rate around 4% is a realistic target for longer-term bond yields over the next few years. This is actually close to the average since 2000. But a move up to 4% is still a substantial increase in interest rates from the current level, and something investors will need to take into consideration when they're looking at their bond portfolios. If the consensus view is right, and the low and long-term bond yields is behind us, that means interest rates have more upside than downside. But what impact will that have on your bond portfolio? And what, if anything, can you do about that? In our view, the 3 key elements to managing a fixed income portfolio are to manage interest rate risk, manage credit risk, and diversify. In terms of managing interest rate risk, the spike in rates from May until September provides a good illustration of how the maturity of a bond affects its performance when interest rates rise. The impact on long-term bonds was much stronger than on short-term bonds or intermediate-term bonds. This is one reason we continue to suggest that investors concerned about rising interest rates should focus on short to intermediate term maturities rather than long-term bonds for their portfolios. When we look at constructing a fixed income portfolio, we tend to think about different maturities as serving different purposes. The short-term securities help hold down volatility and provide flexibility to reinvest since they mature frequently. The intermediate-term maturities provide a higher yield with some sensitivity to changes in interest rates, while long-term bonds generally produce more income but with a higher risk of price declines when interest rates go up. From a credit perspective, the higher yields should provide compensation for the risk of default, but we think finding the right balance between interest rate risk and credit risk is important when you're making asset allocation decisions in your fixed income portfolio. If you're going to be aggressive about credit risk, you probably don't want to take a lot of interest rate risk at the same time, so you might want to limit the maturity of riskier bonds such as high-yield bonds. For the longer-term bonds in the portfolio, we suggest focusing on the higher quality bonds with the lowest credit risk, such as treasuries and highly rated municipal bonds. The third factor is diversification, especially in riskier sectors of the market. These tend to be the most volatile and often the least liquid. It helps to have a mix of bonds from different issuers. That way you limit exposure to any one entity. Also, some bonds are more correlated with stocks than with U.S. Treasuries. For example, high-yield bond prices tend to move with the stock market over time. If you're allocating to these more credit-sensitive sectors of the market, take into account what impact that will have on your overall portfolio. Finally, always keep in mind that timing the market is very difficult. A lot of investors remain sidelined for years because of fears of rising interest rates, missing out on the chance to earn income and compounding that income over time. Recently, the Nobel Prize in Economics was awarded to 3 professors who have done groundbreaking work on how assets are priced in markets. Ironically, their theories tend to contradict each other about whether markets are rational and efficient or not, and over what time frames. If the Nobel laureates can't agree, then it probably makes sense to try to construct a bond portfolio that can weather the ups and downs of the market by staying well diversified across time and sectors of the market.